So this is FIN451, Backtesting and Investment Strategy. My investment strategy, the argument I'm making, American depository receipts versus their respective markets. Is it the same and is it safe? So I want to say that foreign American depository receipts have a stronger relationship with their domestic markets, which is the foreign market that it's in, their home market as a foreign country, is in a stronger relationship than the market they are trading on as a depository receipt. So an example I have is an American multinational corporation. I've chose Philip Morris International, and an international company, British American Tobacco. British American Tobacco is headquartered in Great Britain. It is an exchange on the London Stock Exchange. So the domestic market for Philip Morris International, the New York Stock Exchange, and the domestic market for British American Tobacco is the London Stock Exchange, traded in America as a as BTI ADR on the New York Stock Exchange. So how much is an ADR affected by the American market versus its domestic market? And this is the data that I pulled. I pulled roughly 8 years of data. I have 416 or 17 data points. These are the weekly returns that I have. This is Philip Morris's closing price at the end of every week. And like I said, it's 400 and something points, roughly 8 years worth of data. And then this is simply their return that I have with the stock return for that week. Over here I have British American Tobacco as an ADR traded on the New York Stock Exchange, the same exchange that Philip Morris is traded on. This is the S&P 500, the market that I chose to run regressions and correlations for these companies. And then we have British American Tobacco again on its home market, the closing price in pounds, of course, because it's traded on the London Stock Exchange. And then this is their returns that they managed on the New York Stock Exchange. This is again weekly data. And then I had the London Stock Exchange itself. This is an index for the London Stock Exchange. This is what it closed in weekly returns. And this is its actual return right here. So the first regression I'm going to run is a regression for Philip Morris International against its home market, its S&P 500. And right here I have a absolute correlation, this multiple R, telling us what our correlation is. And then right here we have our R squared, simply multiple R that is squared. This is going to tell us how well we fit on the actual line of regression, which I will show in just a few minutes. Looking at the coefficient correlation between the two, between PMI's stock return and the return of the S&P 500, I note a positive semi-strong relationship between PMI's returns and the S&P 500. So then we have to ask ourselves, is this significant? And it is. I'm having an absolute T-stat of 14.1613. Our rule of thumb for coefficients being statistically significant is an absolute value of 1.6 or greater, and so I obviously have that. So I come to my conclusion that we do in fact have statistical evidence that Philip Morris International's stock returns are in a positive, semi-strong relationship with returns of its market being the S&P 500. So just looking at a graph showing this semi-strong correlation, this is the trend line that runs right through the middle, how well these data points fit on the regression line noted right there. And as you can see, it's a semi-strong positive relationship between the PMI's returns and the returns of the S&P 500. So now we're going to go ahead and we're going to look at the British American Tobacco receipt. This is the American receipt. This is British American Tobacco traded on the S&P 500, and we have a correlation again of 0.55, an absolute correlation, and then how well it fits on that line of regression is a 0.3042. And then noting down here, we have again a positive semi-strong relationship between the foreign company traded on the American market and the S&P 500 of 0.6289. The T-stat being 1347.07 it's statistically significant, yes. So I do have the conclusion that we do have statistical evidence that BTI's ADRs, a stock return, are in a positive semi-strong relationship with the returns of the S&P 500. And this is a graph noting that correlation and those returns. It is in a positive semi-strong relationship, almost as strong as PMI and the S&P 500 itself. So this is British American Tobacco's ADR with the London Stock Exchange. This is not the exchange that the ADR is traded on. The ADR is traded on the New York Stock Exchange. I ran a correlation for this. I got an absolute correlation of 0.3080. Still a positive relationship, but not too strong. This is going to tell us how well we fit on the line of regression, which is somewhat weak with 417 data points. Our correlation coefficient between the ADR returns and the returns at the London Stock Exchange are a positive, very weak relationship. The London Stock Exchange, it's not traded on the London Stock Exchange, so we would expect something of that nature. It is statistically significant, so based off of this, we have no statistical evidence that BTI's ADR stock returns are in a relationship with the returns of the company's domestic market, being the London Stock Exchange. So my conclusion is that I do find it safe to invest in solely based off of this model in a foreign company on the New York Stock Exchange because of little foreign risk that is traded as a depository receipt, since its movements are affected largely by the American market. So this is again just showing that correlation is not a very strong one. And last but not least, this is the correlation with the returns of the company on its home market, BATS.L, the actual security that's being traded on the London Stock Exchange. And we note that this could be due from the fact that British American Tobacco does not do very much business on its home market, because I do have a positive weak relationship again with the actual home financial security, the home stock, the BATS.L, with the London Stock Exchange. It is statistically significant. So I also have no statistical evidence that BATS.L's stock returns are in a relationship with the returns of the domestic market, being the London Stock Exchange. So I still find it safe to invest solely based off of this model in a foreign company on the New York Stock Exchange because of little foreign risk, traded as a depository receipt in America, is since its movements are affected largely by the American market. Thank you.